And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is Lance Roberts, CIO or Chief Investment Officer at RIA Advisors, with approximately $1 billion in AUM or assets under management. Lance, thank you so much for coming on the show today.
I am glad to be here. Thank you.
So Lance, I always like to begin. Can you tell us how you got started in the business and give us your story?
Sure. So now you have to remember I'm old. So my career started actually in 3 days before the crash of 1987.
Okay.
I was actually left college. And after I left college, I went to work for a bank in Austin, Texas. And my boss had me thoroughly convinced that, and I was managing the treasury book for CD deposits. And, basically people would make a CD deposit and then we'd match the treasury duration to the CD, et cetera. Back in the day, that actually worked.
Right. There was actually a yield on the CDs, right?
Yeah. CDs were like 9%. Yeah. CDs were like 9%. I mean, right. It was easy money. And so the market crashed. My boss had me completely convinced it was entirely my fault. So,
wow.
Yeah. Well, I didn't know better. I was this young, stupid kid out of college. Right. But shortly after that, a little bank out of North Carolina called North Carolina National Bank, NCNB, was going around the country and buying up banks. And they bought up First City in Texas. They wound up buying our bank, and they were buying us up and just shutting down the banks and building out their base. NCNB, which everybody nicknamed Nobody Cares National Bank.
Nice. Because
they just shut all the banks down that they bought. Right. Eventually became Nations Bank, eventually became Bank of America. Right. So that's the evolution. Well, when they bought me out, I actually had some friends overseas managing money, and I went and worked overseas for about a decade, managing high net worth for individual investors, mostly French citizens that wanted to keep their money out of France. France is where the U.S. is headed. They were pretty much a very high tax social country. Mm-hmm. So about 80% of your income was taxed. Now I'm telling you this detail because this also is the background of why I invest the way I invest. So these French citizens didn't want to bring their money back into the U.S., so they stored everything outside the country. So I worked out of a bank.
Said the French citizens didn't want to bring their money into the U.S., or they don't want to bring
I'm sorry. My apologies. They didn't want to take it back into France.
Okay.
So as a U.S. citizen, I managed money in the U.S. through a French bank, actually in Monaco, called Montepaschi Bank.
Got it.
And so here's the interesting thing about this. Those investors weren't concerned about what the market did from one day to the next. Their primary goal and consideration was don't lose my money and make me money. But right. The first and foremost conclusion is don't lose my money, because if you're just going to lose my money, I'll just pay the tax and bring it back into France, right? So that was the primary consideration. So we did a lot of market investing, we did real estate, we did a lot of different things, but the primary goal was risk management. So when I got back to the States, this is now the late 90s, I opened up my own broker dealer at that point because I was bringing those offshore operations back into the US,
right,
and managing money here. And so I opened up a broker dealer and brought that philosophy back here to manage for our clients, this idea of providing professional risk management to portfolios with a bent towards capital preservation. Mm-hmm. In 1999, I started writing articles about the coming bust in the markets and why you needed to be a lot more concerned about risk and management. Of course, the dot-com crash came shortly after that. In 2007, we were writing the same articles about the risk to the real estate market, the risk to markets, why you need to manage money better and control risk. And what we saw during this period is that most advisors don't apply a risk management philosophy. It's just, hey, put your money in the markets and markets always go up over time.
Right.
And what people forget is
they do this, right? Lance?
Yeah, exactly. Well, the thing is that there's two lessons you need to learn about markets.
Yeah.
The first is that markets do not return an average of 8% a year.
Right.
Okay, over the long term, 120 years, yes, the markets have returned an average of 8% a year, but you don't get averages. What you get is what markets actually give you. And if you spend a decade getting back to even, as we've seen previously in the past,
yep,
getting back to even compounds your loss over time. And what I mean by that is that if I lose 10% in 1 year and I was supposed to make 8, I'm now down 18%. The next year, if I get back to 0, I'm still down 16% because I didn't make the 8% for the 2 years I was supposed to make.
So on and so
this is it's a compounding problem, AKA pension funds,
right,
which have the same problem.
Right.
But this is why investors don't wind up making money over the long term, because they get trapped in this idea when markets are rising, there is no risk.
Right.
And that's more prevalent now than ever at the moment. But
I was going to ask you if you had an article coming out now about the same thing in 07 and 99, but that was a separate question.
Actually, just I'm finishing one up for next week. So
Nice.
yeah.
Nice.
But yeah, but what happens over time is this destroys the compounding. People talk about compounding of capital. Capital does not compound if you lose money. And what compounds? If I buy a bond, let's go back to my 1987 CD scenario, right? I buy a CD, 10 years, 9%. Every year I get 9% on my money, regardless of what else happens in the world. That's compounding of return, because every year I get that. Markets do not compound. If you spend a decade getting back to even, that is not compounding your returns. It is actually a destruction of principal relative to inflation.
Right.
And this is the big thing that investors miss when they get wrapped up into the headlines. Look, I get it, right? I mean, right now you look at the markets, they're just going up, option speculations off the roof.
Yep.
I get people emailing me every day right now about, oh, it's so easy to make money. Had a guy actually email me, just quit his job as a construction worker. He's now day trading full time.
Oh, no.
The last time I saw that was in 1999.
Yeah.
And I'm not saying this is 99 again, but you're seeing a lot of similarities, SPACs, IPOs of non-revenue generating companies,
No question. No question.
So sorry, brief history. That's how I got there. Wasn't so brief. I apologize.
Yeah, no, that's good. So JFK's dad, Joe Kennedy?
Yeah, of course.
Yeah. So his big story, he made his money bootlegging way back when. And then in the roaring 20s, 100 years ago, he crushed it in the market going long. And then one day he was shining his shoes. And the shoe shiner, i.e. your construction worker, had said, hey, Joe, he's bragging about how much money he was making trading stocks. He gets out supposedly and he goes short, and then he made a killing in the 1929 crash. And then he became later the SEC started and he became the head guy and blah, 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 blah. But that reminds me of that story, because once you start seeing that froth, it's just it's palpable.
Well, yeah, look, we see this every time, right? Here, what things do you see at market peaks, right? So things you see at market peaks is that you got the shoe shine boy, the store clerk, your Uber driver, your Lyft driver, AKA today, giving you stock tips. You also see things like IPOs of companies that don't make money. And IPOs are an interesting thing. One thing investors need to learn about Wall Street is a business, right? Yes. UBS has one of my favorite slogans of all times. UBS, it's you and us.
Right.
No, it is them selling stuff to you.
Right.
And that's their job. Their job is to create revenue. Wall Street is a business. Their job is to create profits. And what is the job of any business? To sell you a product. And so what's the product Wall Street makes? Wall Street makes the product of securities. So if I have a company that wants to go public, I bundle them up and I sell you the IPO. What is an IPO? An IPO is a group of private business owners that are selling you shares in their company. Now, do you think that those insiders of that company are doing you a favor and selling you shares at a discount to what the fair value of the company is? Hell no. They are selling at the highest possible premium they can get. And obviously, if you overpay for an asset over time, you're not going to wind up making money. So, but you see IPO frenzies at market peaks. You see Uber drivers giving you stock tips. And the one thing you see more than anything else is fraud. The one thing that pops up a lot, and we've seen a lot, just recently a story about the advisor in California that tried to escape the feds on one of those jet-powered underwater submarine things.
Crazy.
But you see a lot of that at market peaks, and that's where it's just the culmination of greed has reached that point to where nobody cares about the risk and everybody's just looking for the next hot deal. And that is rife for a market to create fraud in. But this is what you see, and we're seeing a lot of that right now. Now, again, I want to be clear. I'm not saying the market's about to crash. Do not say what I'm saying. We're talking about risk management. And all I'm saying is that you've got a lot of signs of excessive risk-taking exuberance in the markets right now.
You ever see the movie Lord of War with Nicolas Cage?
Of course. Who hasn't?
One of my greatest lines ever. He basically starts from nothing, rises up, becomes an arms dealer for those that haven't seen it. And then, of course, he crashes and goes way back down. At the peak of his quote unquote success, he had a great line. He goes, I suffered the curse of invincibility.
Yep.
And that's what reminds me of traders or investors or risk, their appetite towards risk, or how they just throw caution at the wind during those peaks or those inevitable tops in the market. They suffer the curse of quote unquote invincibility. That's a really good point that you just brought up. So Lance, tell us a little about your investment strategy, if you don't mind.
Cash, CDs, just no.
I was about to say, like, that's great. $1 billion in cash and CDs.
Exactly. We're all in cash.
That's it.
No, and that's what people think though, right? Honestly, so I write a lot of articles, and if you go to our website, realinvestmentadvice.com, sorry for the shameless plug.
No, by all means. Say it slower so they can hear you.
Realinvestmentadvice.com.
Not investments, but investment.
Investments, yeah,
Okay.
Just real investment advice. And that whole website generated from this idea of just saying, hey, let's talk about risk and what is risk management. And when people read our articles, they go, oh, he's bearish, he must be all in cash. And that's not the point at all. We talk a lot about risk. What's the risk in the markets? What do you need to be watching out for? What are the things to pay attention to? Because ultimately, risk is a double-edged sword, so to speak. If I go to gamble in Vegas and I bet a lot on a hand, right, and I win, so I took risks to bet on that hand. I could have lost, right? So it's a double-edged sword. I can either make a lot of money or I can lose a lot of money. And risk is never about how much money you make. It's about how much money you lose when you're wrong.
Right.
So we talk a lot about, so we're invested, right? Our portfolios are fully invested into the markets right now because markets are going up, trends are positive. We want to be there. We want to make money for our clients, but we focus a lot on the risk. What are the things that could go wrong that could destroy a lot of the capital for our clients? Let me give you a good example. January and February of 2020, we were writing about the market, a market correction was going to occur.
Right.
In February, we started writing articles about how we were taking money out of the markets. We were talking about there's too much exuberance in the markets, too much risk. We're taking money out of the market. And of course, you know what happened in March.
Yeah.
So we talk a lot about these things it's basically a publication of our own internal research talking about how we're managing our clients' money. So that's what we write about.
Nice.
So that's our philosophy. So our philosophy about managing money is to participate when markets are rising, but to understand what the underlying risks are that could take away a lot of our capital very quickly. So in March, during that decline, we were down about 8%. Market was down 35. After the market bottom came back, we started allocating back to the markets. So that's just a function of how our process works. We have a primary fundamental process to select equities that we buy. So, and fundamentals are fantastic, but if you're a fundamental investor, you're going to lose pretty much most of the time during mania markets because nobody cares about fundamentals. But we are a fundamental investor. We do want to buy good quality companies. And look, we own Apple, Microsoft, we own Amazon, we own, all these companies. We own Chevron, Texaco. We own a lot of the big names, right? And we don't own things that we can't justify earnings valuations for, right? So when you have Tesla trading at 1,300 times forward PEs, we can't justify that. They are not going to own the entire car market. So we don't own Tesla. Our bad, but that's just the way we work.
Right.
But in order to understand how to allocate money, if you were just buying fundamentals, you wouldn't buy any stock right now because most every stock is overvalued fundamentally. So we have a technical overlay that we put on top of this. Now, here's the key sentence to our philosophy. Fundamentals tell us what to buy. Technicals tell us when to buy it or when to sell it.
Right.
And a lot of people get too wrapped up in the technical overlay. They're like, oh, it's you're trying to day trade the markets. No, that's not the question at all.
Right.
We don't go all in or all out, but we do increase exposure when the technicals tell us that we're in a good trend in the markets. Just yesterday, as an example, we were talking about the fact that we're increasing our equity exposure to portfolios because now we're moving the seasonally strong time of the year. Right. A lot of our technical indicators are becoming stronger at the moment, so we added some exposure. We'll take that off again probably after the 1st of January. So we increase exposure to participate with markets. We decrease exposure to avoid risk. But we're not all in or all out. And that's the key measure. Nobody can time the market successfully over time. They cannot be all in or all out successfully, repeatedly. And what the primary focus of any investment discipline is to be consistent. You've got to be consistent in generating returns over time. Does that mean you're going to beat the market every year? No.
That's okay.
And it doesn't matter.
Right.
It doesn't matter whether you beat the market. Let me give you 2 things about beating the market that you should pay attention to more importantly than anything else, is that first of all, the market is not you, right? The market benefits from some things that you never will. The market itself has no cash.
Right.
They have no fees. They have no expenses. They have no trading cost. They do not pay taxes. They do not do any of these things. They don't have to pay for an overhead building for lights and sounds and all the other things. They have no employees to pay for.
Salaries,
it is a mathematical calculation of some ethereal paper securities that make up this index. It has nothing to do with you. It has an infinite duration and no real long-term capital risk in terms of how money works over time. Your portfolio, by the way, has all of those functions.
I was about to say, there's no cost of doing business. There's no cost of doing business. Right.
You're exactly right. You pay taxes, you have trading costs, you have all these other things, but more importantly, what you don't benefit from are from things like share buybacks.
Right.
When a company in the index buys back shares, it changes the market cap valuation of that index. It does not affect your portfolio. Bankruptcies do not affect the index because they do what's called substitution, but a bankruptcy in your portfolio has major effects to your long-term capital. Right. You are not the index, and benchmarking yourself to an index is going to hurt you more often than not because it requires you to take on too much risk. The best index that you should use is your own personal rate of return that you need to reach your retirement goal on time, and be realistic about that. It is not 8%. It is not 10%. It is not 12%. It is probably about 4 to 5% to be successful long-term.
That's a those are very, very good points. Not even very good points, just very good points, because most people get caught up with quote unquote beating the index, and they're stuck in this endless loop of, 1 year they have a good year, the next year they don't, like you mentioned earlier. And the other side of it too, with the compounding, where if you try to beat the index all the time, like you said, you're going to have years and years with that negative compounding kicks in, or whatever you want to call it, of missing out the opportunity cost of compounding. And the other side too is when you're down 10%, you need an 11% gain to get back to even. You're down 25%, you need a 33%. You're down 50, you need a 100% gain to get back to even. So these are really, really good points, Lance. So
that math thing is difficult.
It's very tough. Most people just don't get it. It goes right over their head. Yeah, I fully get it. To illustrate the point, in case people are following and they don't get it, if you buy something at 100 and it goes down to 50, you just lost 50% of the value. In order to get back to 100, it's now at 50. It's got to go up $50. It's got to go up 100%. How often does something go up 100% after it just fell 50? So the math isn't one-to-one. Most people think, it went down 50%. It's got to go up 50%. No, it doesn't. At that point, it's got to go up 100. So on and so forth. But those are really good points. So Lance, in the portfolio, you use fundamentals. You spoke about value. How do you determine value? I know value is very subjective, like beauty, but how do you determine value if you don't mind explaining a little bit?
Yeah, so value investing has changed a lot, particularly over the last decade, because of things like share buybacks. You used to be able to look at valuation measures like EBITDA, earnings before interest, taxes, depreciation, amortization, or just basically earnings per share, right? You could do a lot of these things. The problem with share buybacks, and this is a big misnomer in the market, is share buybacks are a return of shareholder capital. That is absolutely not true. Shareholder capital is only returned to you as a buyback if you sell your shares. Then you no longer own your shares, right? You do get the money from selling your shares, but you don't own the shares anymore. So it's not returning shareholder value to you. It's just simply removing shares from the market. That reduction in shares that we've done over the last decade, we've done a lot of it.
Yes.
Has tremendously boosted the underlying earnings per share. Let me give you a quick number. Please. The market is up 400% since 2009. Operating earnings are up 273% cumulative over that same time frame.
Right.
Guess what? Revenue. Now, revenue is what happens at the top of the income statement, right? So everything else happens after that. So I have revenue, and then I subtract out all my expenses, blah, 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 and I have what's left over is called earnings. And then we say, okay, well, Wall Street doesn't really want to know what your real earnings are. So tell us what your earnings would be if we strip out all the bad stuff that you actually paid expenses for and those type of things. Oh, those are operating earnings.
Right.
As Charlie Munger says, those are BS earnings.
Yeah.
But those earnings are what we report, right? So operating earnings have grown by 273% over the last decade. Revenue at the top line has grown by 43% total.
Wow.
Corporate profitability is now lower than it was. If we look at corporate profits after tax, now this is what corporations actually report to the government for taxes.
Right.
Corporate profits after tax are now lower than, or as low as they were back in 2009 following the financial crisis. So corporate profitability has not grown at all over the last decade.
Is that a percent of, corporate profitability? Is that just a straight up earnings, like a dollar amount, or is that a percent of the revenue, or how do you determine?
So for instance, you can go to the Federal Reserve website, Fred.
Yep.
And you can plug in corporate profit after tax, and it will bring you up corporate profits after tax with inventory adjustments, right? So they adjust for inventories, and this is corporate profits after they pay tax. That's what's the actual dollar value reported to the government, right? For IRS purposes, right? That number is the same level as it was back in 2009.
Wow.
And that's only because it declined here this year. But previous to March, right? Yep. Corporate profitability was the same level as it was back in 2014. So even though the market has been accelerating in terms of price, corporate profitability has not grown at all over the course of the last really 6 years. And that's why but that's because revenue is not growing.
Right.
And that's the real problem, is that we have this booming market that is so far ahead and so disconnected of underlying revenue growth that valuation is becoming much more challenging to do. So when we're looking at so now back to answer your question, the problem with a lot of the metrics, anything based on an earnings per share basis, earnings per share, EBITDA, price to sales ratios, all those type of things are all vastly manipulated because of the underlying share buybacks, and that has increased
the playing field. Yeah, it's huge.
Exactly. Yeah. So when we're doing fundamental valuation, we go in and we basically back out all those share buybacks to get what the real revenue growth is.
Oh, interesting. So you actually go back. Yeah, go ahead.
Yeah, we go back, we strip out all the buybacks, we put the share count back to where it was basically before they started doing buybacks, and said, okay, now how much have they really grown? And it's a fascinating study when you do this, because you realize companies like Apple have not grown revenue in 5 years.
If you take out all the buybacks.
If you take out all the buybacks.
Wow. So but on a dollar to dollar basis, revenue's grown, but that's with the buybacks because it shrank the float.
It shrinks. So when they report their revenue, it's revenue per share, right? So you back out all the share buybacks, and all of a sudden revenue really hasn't grown. But that tells you a lot about the business. But again, this shouldn't surprise you, because economic growth has been growing at basically 2% over the course of the last decade. So you've had very slow economic growth. And let's clear up something really quick.
Yeah.
Everybody says, well, the stock market's not the economy. True. Except that all the revenue comes from the economic growth that occurs within the economy, because what you spend is where economic growth comes from. Consumption is 70% of the economy, and your spending and consumption is where revenue come from for corporations. So yes, the stock market is not the economy. It's just where all their revenue comes from. So eventually economics matters.
Right.
But that's why we do a lot of manipulation when we're doing our valuation adjustments. And look, there are times that we just look at a stock and go and buy it.
Yeah.
Because
you do one of these.
There are some things that you just can't justify, and you say, look, I've got to have this exposure. It's going up. So there are parts of our portfolio that are momentum driven. Right. And there's a big chunk of our portfolio that's value driven.
Understood. No, that's a really good, that's very smart, actually. I've never heard anyone look at the market and then reverse engineer it to get the true reading, minus the interferences, if you will. External events that interfere with the quote unquote numbers that we're seeing. So you speak a lot about the difference between Main Street and Wall Street, but you haven't mentioned the Federal Reserve artificially keeping rates at zero, pumping money into the system, so on and so forth. What are your thoughts on that, and how that's interfered, if you will, or impacted markets?
Well, I mean, let's see, markets are at all-time record highs. You've got an economy that's in a recession. I mean, you tell me.
That's a question.
Yeah. Well, look, here's the thing is, the Federal Reserve is doing what they're doing. Central banks globally are injecting capital into the markets. And, I wrote an article recently called Neil Kashkari, who is the Minnesota Fed governor. Yeah. I said, he is the definition of moral hazard. And the reason is he said that the Federal Reserve interventions have nothing to do with the stock market.
Yeah, I saw that.
And technically he's correct, except for the fact that when the Federal Reserve puts excess reserves in the banks, what he forgets is that the banks are taking those excess reserves and running it through their proprietary trading desk and trading securities. If you don't believe me, look at the earnings reports out recently from all the major banks like JP Morgan, Goldman Sachs, Bank of America. They made no money loaning money to you to go buy a house. Yeah. Where did they make money? Trading revenue.
Yeah.
That's where all their revenue comes from. So that's what's driving markets. And let's talk some real quick about moral hazard.
Please, yeah. Well,
what is moral hazard?
Sorry, Lance, if you don't mind, just define it in case someone's not familiar, and then please talk about it.
Yeah. So moral hazard, this is the article. So if you go to our website, realinvestmentadvice.com, just type in moral hazard in the search bar, you'll get the whole article on basically just beating Neil Kashkari just for fun. But moral hazard is when somebody takes on risk because they believe they have insurance against that risk. So here's a good example of this. I go to Vegas. I sit down at a poker table. I'm going to play Texas Hold'em, right?
Yeah.
So I get a hand and I've got nothing matching in my hand, right? I don't even have a pair of twos. I mean, that's how bad and normally that's the hands I get.
That's why I don't play.
But Las Vegas has guaranteed me that my first $1,000 that I bet, they will give me back my money if I lose it. So I have an insurance against my bet. So what do? I bet all in. Doesn't matter what I have. I bet all in because if I win, I'm going to win a lot. If I lose, I get my money back. That's moral hazard.
Good.
And that's what the Federal Reserve has now done to investors is by training them over the last decade, QE1, 2, 3, Operation Twist, QE4, that we can't have a correction. But I want to remind you that starting in September of 2019, the Federal Reserve was doing QE4. They were doing repo operations in the background to help support the banks because they were under a lot of pressure because of the inversion of the yield curve. And so QE4 was already intact, and we still had a 35% correction in March. So, and by the way, we were writing articles in September of 2019 telling you a recession was coming, but nobody believed us then either.
It works. The crowd's usually wrong. Yeah,
exactly. Oh, you're just being bearish.
Yeah, seriously.
Well, it works out. Yeah. Anyway, but the point here is that simply, that belief now is like Pavlov's dogs, right? We ring the bell and investors run in to buy stuff. It's a very dangerous concept because honestly, the Federal Reserve and central banks do not have any direct tack over financial markets. The financial markets have been trained to run this bell, but eventually there is a point to where those programs no longer have what we call efficacy.
Right.
We did a study on this recently and looked at each Federal Reserve program. In the first program, the return on every dollar the Federal Reserve put into the market was about $1. So they put $1 in, they got $1 back in terms of market returns. It's now taking $2.50 of Fed intervention to get $1 worth of return. Mm-hmm. So the diminishing rate of return is becoming greater and greater. And if you don't believe me, go take a look at Japan, who now owns 80% of their bond market, 80% of their stock market. The Nikkei is still 31% lower than it was 30 years ago.
It's crazy, yeah. It's almost like the drug addict who builds up a tolerance, or the drunk who keeps drinking. He needs more booze to get drunk or get that same high or whatever word it is. Yeah, 100%. First time you
trust me, if this market keeps going the way it is, I'll be figuring that out myself. So
that's it. No, that's great. So you said that's the moral hazard. Then you were going to explain how that's been impacting where we are now. So it's $2.50 to every dollar for the Fed to go. Do you think that that's going, I mean, eventually it's like a game of musical chairs, right? The music's going to end, meaning the market's going to stop responding well to the Fed and all the easy money that's being injected into the system. Just out of curiosity, what happens in your opinion then? Is it the mother of all bear markets, or is it a dead decade or a dead 2 decades? Or I know you have no idea, neither do I, but I'm just curious of what your thoughts are.
Well, so in theory, right, there is a limit to what the Fed can do. So the Fed can only monetize what the government issues in terms of debt, right? And the Fed really hasn't been doing a whole lot lately because the Fed's not been doing, the government's not been issuing a lot of debt, no stimulus packages. Now, hopefully they'll do one here shortly. And that'll give, the Federal Reserve some more firepower. But it's interesting, if you take a look at the Main Street lending program they did, the PPP program, which, they're wanting to fund more in the PPP program, which was rife with fraud.
Right.
But they didn't even use all of the last.
I saw that.
Very little uptake in the Main Street lending program, very little uptake in the bond market program they did. So the impact that they have on certain areas of the market is actually very minimal. Mm-hmm. The biggest impact they have is on QE, which flows directly into equities, and that's the biggest impact. The problem with that is that it's created a massive gap between the wealthy and the poor. The top 10% of income earners own 90% of the stock market.
Crazy.
Yeah. Everybody else owns the other, 10%, which isn't much. So that's why we have this big bifurcation in the wealth gap. That's going to get worse. That eventually leads to social unrest, riots, and ultimately revolution at some point, right? So,
at the new case.
Yeah, you can keep doing this, but it's not great. But there's also just a limit. I mean, there's only so much debt that they can absorb.
Okay.
And the idea that we can just print money with no consequence is completely idiotic. Ultimately, you have to deal with the debt. You cannot issue a debt and not pay it. There's the belief that what the belief is that the government's debt is somebody else's asset.
Right.
And so we can just basically wipe out the government debt. That's fine. You just wiped out somebody else's asset who's depending on that money and that income for consumption, right? Or productivity.
Yeah.
So there's no free lunch in any of this, and it all has consequences down the road. What the hazard that we're creating though is that by not dealing with the underlying issues of the economy, and look, recessions, I'm going to say something that's going to just curl people's toes. Recessions are a good thing.
Yeah, that's healthy. It's normal.
Let recessions happen. Look, I know they're painful. I know people lose their houses that they bought that they couldn't afford to start with. I know people lose their jobs, which allows them to move somewhere else and get a better job somewhere else when the economy recovers. These things can be very healthy. And the bankruptcy process, allowing companies to go through bankruptcy, is a very healthy process. It gets rid of their debt. People that speculated in these companies and took on way too much risk, they lose out. Sorry, that's investing. Yes. That's part of the game that we all play. Right. But we're protecting the corporations. We're protecting the insiders of these companies. We're protecting the major banks that are trading this stuff by bailing them out repeatedly over and over and again. But we keep shafting Main Street America, which is why you have this big wealth gap. Right. And allowing these processes to occur would heal that. We wouldn't have 5 banks that own 60% of the banking industry if we hadn't bailed them out twice now.
It's crazy. They had too big to fail back in 2007, 2008. Now it's way too big to fail. I mean, seriously.
Now everything's too big to fail, right? Airlines, cruise ships. I mean, come on, give me a break.
Yeah, it's really crazy. So this is really good, Lance. A few questions now, just timeless questions. What are some timeless lessons you've learned along the way that you'd like to share with the audience?
So if you want to be a good long-term investor, 3 things to start with. Turn off the television, quit reading the Wall Street Journal, and start doing your own research. The reason is that most of the stuff you get from the media is pretty nonsense for the most part, because again, you're a long-term investor theoretically, right? You're investing for the long term. You want to be doing the research, buying companies that can generate long-term returns. Too much of the nonsense that comes off television gets you wrapped up into chasing markets, taking on too much risk. And the biggest challenge of any investor, and if you go back and look at, and we have numerous posts on our website about the rules of investing, and we go through a lot of stuff, from great investors of our time. And what you'll notice is that within some form or variation, whether it's Paul Tudor Jones or Warren Buffett or Elliott or anybody else, right? They all have some very similar rules. Buy low, sell high. Don't buy losers, sell your losers, trim your winners, those type of things. These are very basic. Right. Yeah. These are very basic rules about investing. But when we start listening to the media, we get all wrapped up in the emotions and we get away from our discipline. And that's the most important thing. I mean, to be a successful investor over time, you just have to have a discipline and adhere to it. But that's the most difficult challenge, is adhering to your discipline, particularly when it's not working.
Right.
And no discipline works every single time.
Cycle. Right.
Right. So look, if you're playing baseball and you're batting 400, you wind up on the Hall of Fame.
Yeah, of course.
Okay. What is 400?
You struck out 6 times, right?
Exactly. You hit 4 out of 10, right? I mean, that sounds horrible. Right. If you can bat 60 or 70% of your trades over time, you're going to kill it. You will be very wealthy and you'll make a lot of money. But managing risk and managing returns is not about being right all the time. And the things that we do wrong is that we sell our winners, we hold on to our losers, hoping they're going to come back. We buy high and we sell low. We do everything exactly backwards because there's too much interference from all these outside, television and media, commentaries, Twitter and Facebook and all this other nonsense. Turn all that stuff off. focus on your research, and you can do a lot better investing over time.
Yeah, I love that. I always like to say, the job for the long-term investors is to look at the forest, not just the trees. When you look at every single tick, it's almost like having tickositis, when you have bronchitis or some kind of itis. And then what happens when you do that, or looking at the news every 5 seconds, or looking at your phone and seeing where the stock is now, you're looking at the leaves on the trees. You're not even seeing the trees, and forget the forest. You're just staring at the leaves. So you miss the whole big picture. That's a really, really good point right there. So how about some timeless mistakes that we haven't covered already? What are some timeless mistakes, either on or off Wall Street? I love the consistency too. That's really powerful.
Well, look, the mistakes I've made over time are always the same, right? And they're the same that everybody else makes. I let my emotion get the better of me. I mean, I'm human, just like everybody else. And some of the worst trades I've made is, buying things where it's like, oh man, this is, I missed it. I've got to get into it. No, you don't. And I try to minimize those mistakes. And whenever and here's a very important thing that I do that you should do as an investor. Write down every trade that you make, when you buy it and when you sell it, and write down the reason why you did it. Mm-hmm. And the reason for doing that, by keeping a log of that, you'll start to realize your trends and your mistakes, and then you'll stop repeating your mistakes. But even with that, I regularly write mea culpas on newsletters and things like that, saying, hey, you know what? Sometimes I have to learn the lesson over again. Sometimes you got to get hit in the head again just to remember, oh yeah, I don't like getting hit in the head, so let's not do that again. But look, that's part of the game, so the mistakes that we always make are always the same. And this is for everybody. We get tied up into something that's running up because it's just going up and it's doubled, so it's going to double again. And we disregard the risk. We don't look at the balance sheet. We don't look at the fundamentals. We don't do those things, and we start speculating rather than investing. And once we shift from the method of investing, which is a disciplined strategic approach to long-term growth, and we start speculating, then we're simply purely trading a game of risk. Right. And when you start playing that game of risk, you vastly increase your opportunity for loss, because that's all risk is. If I jump out of an airplane without a parachute, that's pure risk, because there's no upside. But that's what we do. And in this market where we are today, this is where you start thinking about selling risk to somebody else. Look, you own a bunch of positions. And look, markets are always about the greater fool theory, right? There's always got to be somebody willing to buy at a higher price than you. Right. So take the opportunity to sell things that are grossly overvalued in your account, sell it to somebody else willing to pay an overvalued price for it. Long term, you're going to wind up making money. No, I love that. So there's fundamental analysis, there's technical analysis. I have a book coming out called Psychological Analysis on Markets. And my belief is just what you said. It's you want to be able to make rational, not emotional decisions with your money. And that's simple, but not easy. Like, it's simple to lose weight, calories in versus calories out, but it's not really easy. Most people are overweight. Simple to make money, cash flow in versus cash flow out, but most people don't have enough money, so on and so forth. So I love what you just said. It's hit the nail right on the head. Well, talk about psychology. I mean, that's a great point. I mean, herd behavior, cognitive biases, confirmation bias, all those things, all those psychological hangups, those are the things that stop us from making money. That's really, that's right in the book. It's just boom, 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 boom. The recency bias, anchoring, personal blind spot bias is one of my favorites, meaning it's not going to happen to me. Like, you ask 100 newlyweds, how many you can get divorced? No one's going to raise their hand. Statistically, we know half of them are getting divorced, right? So, this is great, Lance. So I have a trading question. You mentioned keeping your losses small, letting the winners run. So when you enter a position and you use technicals as well, do you have a predetermined exit? Like, I'm going to exit if the stock drops 8% or 10% or 6%, or do you make decisions to exit based on something else? There's so many. I just want to make smart ass comments right there, but yeah, please, by all means. No, look, this is one of the basic disciplines that you should have if you're going to invest. What happens for most people? Most people buy well, right? They buy a stock, they go, oh, I like this stock, I'm going to buy whatever it is. So they buy it. They have no idea at that point when to sell it, either up or down, right? They just buy it. And then if it goes down a bunch, they go, okay, well, I hope it comes back. And if it gets back to even, I'll sell it. When it gets back to even, they don't sell it because now they think it's going to go up some more, so they won't sell it. And, then you get into a whole big trap, right? Yeah. Whenever we buy a position, we know two things going into that position when we buy it. We know where we're going to sell it if the stock drops a certain amount. So we don't use William O'Neill, one of the great investors of all time. No doubt. He uses an 8% rule. And, the problem with 8% these days is that a stock can drop 8% a day, then turn right around, and go right back up. So we typically use, moving averages or previous support levels or trend breaks, those type of things as our stop levels. Okay. So where does this stock, violate some previous level of support? And then we don't actually sell it right there, because what happens, with all these algorithms today, if you have a support level and you break below it, typically algorithms are sitting right there underneath it, because they know that there's a lot of people sitting at stops. Those stops get triggered. The algorithms are going to buy it underneath, and you pop right back above it the next day, and people go, oh, see, stops don't work. It went right back up. Right. So we have a stop level, then we set a 1% break below it, basically. Okay. And so we allow it time to break below that. If we go back up and test that break and then don't get above it, then we stop out. If we get back above it, then we hold the position and let it keep going. So, got it. And typically it's complicated, but I know it just typically works better for us. Yep. But we have a downside range. Okay. We also have a target to where we are going to sell some, most, or all of the position if we get to that target on the upside. Got it. So we know two things going in: where we're going to sell it if we're right, where we're going to sell it if we're wrong. And, we've bought and sold Apple. And when I say we bought and sold stuff, like Apple, we've owned it forever. We've bought and sold shares of that over time, because when it runs up too much, we trim off profits. Yep. When it comes back down, we add back into the position. So we maintain a relative position size. So if in our portfolio, if a position can be a maximum of 3%, that range can go from 5 to 2. So we can adjust that position sizing within the portfolio, but we always maintain our exposure to stocks and companies that we like long term. Makes sense. No, that's really good advice. My final question, Lance, is what is the best piece of advice on or off Wall Street that you'd like to share with the audience? There's so many. Best piece of advice is, how about that? Best pieces of advice, how about that? Look, the best piece of advice, honestly, is to understand that money is not fungible. And what I mean by that is that we treat money in the market like it's not ours, right? We're just throw it into stocks and hope it goes up. Remember that you worked really, really hard to make that money. And this is the way we approach it for our clients in particular. Like, this is their retirement savings. And the one thing that I've never had to do, I've been doing this for 35 years. I've never sat down with a client and said, okay, we lost 35% of your money. This is how we're going to get it back. Never had that conversation. Never will. I've had plenty of conversations why we didn't beat the market one year, right? Hey, we made money. We didn't beat the S&P, but we made money. We're on track for our retirement. We're good. Yeah. I'm completely okay with that. Just remember, you worked really hard for your money, and money cannot be replaced. And here's the most important piece of advice. Opportunities in the market come along just about as often as a taxi cab in New York City. Well, it used to before the pandemic. Yeah, the bus. Always another bus. There's always another bus. Another elevator, right. Yeah. But losing your capital and then trying to rebuild your capital is a process that you actually never achieve, because once you lose capital and get back, you've also lost all that time of growing that capital to start with. So you destroy your compounding of return over time, and you destroyed the working value of your capital. So the most important piece of advice is always protect your capital first. Mm-hmm. You can always come back to the poker table later to play, but once you lose all your capital, you're out of the game. Yeah, I love that. So it's basically capital preservation first, focus on that, and then capital appreciation second, or it'll happen. It's a function of the process. It'll happen. Just pay attention to the protection of the capital. That's really, really good advice. Well, Lance, thank you so much for coming on the show. Can you give everybody your website one more time, please, just to make sure that they have it? Absolutely. realinvestmentadvice.com. We post a lot of articles there, and we have videos and YouTubes, and there's tons of stuff there. And we've actually even got a subscriber service that runs through there that has all our market data portfolios in it, whole 9 yards. So beautiful. Lots of tools. Thank you so much, Lance. This has been absolutely fantastic. Thank you. Appreciate it.